Hello, everyone. My name is James Rosebush, and I'm Chairman and CEO of Growth Strategy. One of my favorite things to do is talk to investment managers and unpack their strategy and get them to tell me where it came from. Today, we're talking with Joel Klein, who's the Chief Investment Officer of Physics Investment Group. So, Joel, I've heard you talk about the difference between modern portfolio theory and modern portfolio reality or practice. What does that mean to you, and how has it had an impact on the development of your own strategy?
Yes, Jim, years ago when I began my career, I became aware that the vast majority of investors are concerned about having enough money for retirement. And the reason for this is the misuse of modern portfolio theory by the investment industry. And really, because most investors use 401ks and IRAs to invest in mutual funds, they tend to have hundreds of positions in these funds. And the reality is, and I can't emphasize this enough, that over diversification does nothing to mitigate risk. However, it waters down upside performance.
So, if diversification doesn't mitigate risk, how do you view risk mitigation?
Yes, well, 75% of stocks are correlated to the trend of the S&P 500. So a mutual fund with hundreds of positions, for example, in the year 2008, when the S&P corrected 50% plus, mutual funds did the exact same thing. So it wouldn't have mattered if you're in a concentrated portfolio or one of these overly diversified portfolios.
Interesting. So, where you're taking me is telling me that you have a limited number of stocks and a small group of ranking positions. So, how do you then protect those positions against a geopolitical unrest or trade wars?
Yeah, and that's so important. Our research goes back to the year 1900, and it includes every market cycle since then, as well as every leading stock in US history. And so what we know is the S&P over the long term returns about 7% a year. However, every market cycle in US history has generated leading stocks that return 100% annualized or better. And so we realized that by building a concentrated portfolio only of these very best leading ideas, we could mimic their performance and not so much that 7% of the S&P. And this approach has made all the difference.
So, to get to those leading ideas, I'm assuming that you balance artificial intelligence and active investment, and that you developed algorithms to support this strategy.
Yes, this really does call for an actively managed approach. And the reason is we really want to be in those leading stocks early as they begin major uptrends. And when those trends end, we want to rotate into the next group of leaders. And so that requires active management. So we've developed fundamental, technical, and algorithmic investment tools to keep us in the exact right place at the right time.
Sounds like flying a plane, which I understand you do. You're a pilot. So, how do you integrate sight flying by sight and flying on instruments?
Yeah, so that's a great metaphor for portfolio management. Piloting a plane, the beginning of it is all in the preparation, it's all in the details. It's flight planning, it's checking the weather, checking the equipment, and having a plan for every possible contingency. Portfolio management is exactly the same. It's the details and the preparation are everything. And it's so important to have a plan for whatever comes up, whether it be geopolitical or other events. And so it begins with that detailed level. However, we really take a much bigger approach, and we call it a market view from 31,000 feet. And this is a global view of the markets, geopolitics, the economy, all these things. And integrating all of this has just had sensational results.
Well, that really sticks with me, that metaphor. I think it's all about getting there safely and reaching the destination, right? So, it's great to talk to you, and I'll look forward to learning more next time.
Thank you, Jim.